and say welcome everyone to Saturdays with Eddie. So today is October 15. Today we're going to be talking about the market, more specifically the S&P, see how it performed this coming week and what could you have done differently to prepare yourself for that kind of event on Thursday and then on Friday, right? So on Thursday, we saw the market drop and then recover about 100 plus points. And we also saw it recover, or rather retrace about another 100 points yesterday. So that's a 200-point move in just 2 days, up and down. And if you were sitting on the sidelines, you harvested exactly zero. Or if you were on the wrong side, you got hit twice. Yikes. Got hit twice. So how do we prepare for those kind of things? And then the second topic I want to talk about is maybe how to manage a portfolio, any size of portfolio, whether you have $2,000 or you have $100,000. How do you manage that? So that's going to be a little interactive. I want some ideas from you guys and see what your thinking is about that. I think it might be interesting just to kind of get a feel. So, and then obviously I will get your questions. I should probably start with your questions. And that usually helps me, set the tone a little bit. So if you have a question that is burning, I am happy to attempt to answer it. You can type it out. You can speak it out, preferably speak it out. So anyone? Yes? No?
Yeah, I'm a little confused. In the last day or so, I've heard a couple of different things. When an option expires, you lose something. You lose your premium.
Mm-hmm.
I don't understand that. Does that mean you need to close the option instead of letting it expire? And yet some people buy things knowing that they will expire and they want that.
Mm-hmm. Mm-hmm. Yeah, different strategies, different outcomes. So in the basic premise or the basic concept of an options contract is that it has an expiration date, right? So when you buy a call option with an expiration days of 30 days, so it's a 30 DTE contract, that means that its original face value when you bought it is how much you bought it for. But every day, every minute, it decays in value unless the underlying security that it is representing is actually increasing in value, okay? But the premium itself, that's what you're trading. Remember, you're not trading the underlying price, you're trading the premium of the contract. So let's go with some examples for you here just to illustrate. You buy Apple contract, and you're expecting that Apple is going to move from and I'm a visual person, so I'd like to share my screen maybe. Visual. Am I a visual person? How does one know that you're a visual person? Or people just saying it because people say it. I think that's the case. Yeah, people they don't even know what they're talking about. They just know they're visual. All right, so Apple is trading at 138, right? Forget these lines here. Maybe I should even delete them so that they don't confuse us. But it's trading at 138, and your thesis is that Apple is going to increase from 138 to a number like, say, 144, giving you an increase of $6, right, on the price of Apple. Mm-hmm. But remember, you're not buying Apple. When you're using options, you're not buying Apple at 138. You're actually buying the contract itself that represents a certain strike price. So if you were to go, say, 41 days out to the November 25 contract and spend $820, that's how much you would spend. In 41 days, what is going to happen to that contract is if you let it expire and you don't do anything, even if it increases in value, let's say that Apple does in fact go up to $144, but you did nothing with your contract. The question is, what I'm hearing you ask is, what happens to the one contract that I bought for $820? Does it have any value? Well, first and foremost, if you don't sell it and it expires out of the money, you lose everything. The maximum that you can lose is $820, right? If it expires out of the money. But let's say in the event that it expires at whatever price, you don't do anything about it. But now the new price of Apple at expiration is 144. And the question should be, does your contract have any value whatsoever? Because your thesis was correct. Price increased from 138 and went to 144. That's a difference of $6. Is that right?
Yes.
So the answer to your question, the value of the contract that is unsold at expiration, if it is in the money, it would be worth the difference in price, the difference between the closing price of the underlying, which is in this case would be 144, minus the strike price, 138. So do the math in your head there for me. 144 minus 138 is what?
You said 6.
6, right? So $6 in premium is how much in real money?
600.
$600, right? So you're simply multiplying that. So you can see that even though your contract may have increased in value, you did not sell it, right? You did not benefit from that benefit. And we might even ask the question, approximately how much would it be worth at that time,
right,
if you had sold it? Do you know how to calculate that much?
No.
I think it would be worth right about $1,100, give or take. Let's do the math. What's 0.53 times 6? You've got your calculator there with you?
Yes. Get there. 0.53 times 6. 0.53. 318.
So it would have increased by $3.18. So 318 plus 820 is what?
820. 820. 823.18.
No, 8.2 plus 3 point, what did you say? 3.18?
Let me get back. 8.3.
No, 8.2.
3.2 plus
3.18.
11.38.
That would be the value of your premium. That would be of that contract that you bought. If you sell it, you can sell it for $11.38
on the day of expiration,
or even before.
But up into the day of expiration, it increases. I mean, it would have that much value. Who would buy it?
Millions of people will buy it. Yeah, that's not an issue.
Okay.
Yeah, this thing is traded several million times every day.
Okay.
Never worry about who's going to buy your contract.
Okay.
Yeah, that's not an issue. So your opportunity cost, if you chose not to sell that contract, you'd be losing $3.18, which is $318 profit. So you'd be giving up that profit. Additionally, you'd be giving up some of the premium that you originally spent. So the 820, obviously that would be wiped out clean. You lose all of that. But what you're going to be left with is the intrinsic value, right? So intrinsic value is the difference between the current price and the strike price at expiration. A lot of words in there, right? But that's options 101, I think. Does that answer your question?
Why would someone let something expire without
selling it? Well, different strategies. So if you're selling premium, that's a different case. Right?
Okay.
So if you're selling premium, the best case scenario, remember, when you're selling premium, you're selling high and buying back low. So if I sell something for $10 and I want to make the maximum profit, that scenario would mean that I would need to let that thing expire worthless, meaning it has no value. And I would collect all $10, or rather I would keep that $10, yes?
Gotcha. Okay.
But if I want to take the risk off the table, let's say it's fluctuating between $1 and $2, even before expiration, could I just buy it back for $1 or $2 and make the difference between what I sold it and what I bought it? Yeah, that's how you make the money, right? When you sell high and buy low. So
Yeah.
the difference between 8 and let's say we buy it back for $2, that would be $8, and you'd make a profit of 8. In which case you wouldn't care now whether it expires or not. You made your profit.
Okay, so what I'm understanding is if you're buying a
Mhm.
vertical, you want to sell it for
You
sure
want to,
before it
absolutely.
expires. If you're
Yes.
selling a vertical, you can
Mhm.
just let it go. And
You can. And
you don't have to do anything.
sorry, go ahead.
You don't have to do anything after you sell the vertical. You don't have to do anything about recovering the contract. I mean, you don't have to do anything with the contract.
That is one strategy. However, I advise against it because we have seen scenarios where price action has changed direction, and therefore what you sold could now become a liability. You could go into the red. The way to go into the red is if price comes towards your spread. I think you're talking about spreads here. So the fundamental, principle about spreads is that price directly affects the value of the spread, right? So the farther away price is from the spread, the less value that your spread has. And it depends on what kind of spread. So let's take a credit spread, for instance, right? When you're working with credit spreads, you want price to move away from that spread. Yes?
Yes.
But when price is moving towards you, then it is in your best interest to close that position because the value of your spread is increasing. Is that a good thing? That's not a good thing because remember, you sold high and your objective is to buy back low. So if price is coming towards you, then the value is increasing. And so you have to buy it back higher than you intend to. Bad scenario. So, but if price is moving away from you and the expiration time arrives, then it's to your advantage to just let it expire. However, knowing based on how the market has been, you have to be very careful. You have to have a really good knowledge of the security that you're trading, how it behaves, and how the contracts, especially with spreads, expire. So,
okay, I understand. Thank you.
All right. So that's just for credit spreads. Now, the same thing with other type of spreads where you pay to get into when you're going long, right? Like a debit spread. The scenario is the same, except for a few key differences. You still buy into the spread for debit spread. That's why it's called debit. You're buying, you're paying money to get into it, but this time you're, in order to make profit, you're selling it. There are certain conditions where you could let it expire in the money for much, much better profit than if you sold it. Right? There are such instances, and I talk about that in greater detail inside my class. So that's something that we can get together and talk about.
Okay.
Cool. Nice question there.
Thank you.
You're welcome. See who else is out there. Yeah, if you just walked into the room, we're taking questions. What's up, Lindell? You have a question, a comment, saying hello?
Good morning. How you doing? Can you hear me?
Yep, I can hear you. You're doing well. Thanks.
I have a question about momentum. I thought that, before the market opens in the morning, a good indicator would be looking at the futures. If it's in red, if it's negative 1 point whatever, that was a good indication that the market will drop when the market opens, right? Can you just talk about what you look at? Because I was obviously burnt this past week and looking at that. What else do you look at as far as indicators before the market opens to give you good knowledge of what it will do when it opens up? Or am I looking at that totally wrong?
No, you're looking at it correctly. There's plenty of things. There are plenty of things that determine how a day turns out. Okay. So first off, when you look at the futures and they give you a reading, say negative in this particular example here, that just tells you the market is going to open down. We agree on that, yes?
Correct. Yes.
Okay.
At least that's what I thought. Yes.
That is correct. That thinking is correct. And when we say the market, we're talking about S&P 500. We're talking about SPX in this particular case. That's who we're talking about. So when we see the futures, more specifically ES, which is the S&P E-mini futures, with a negative number in the morning at 9:30 or just before, then we understand that S&P is going to follow that trend and open in that direction, down. That is the only thing that it is telling you at that moment, that it is going to open down. It is not telling you that it is going to stay down.
Right, because an hour later it could be totally green
Absolutely.
and plus
Yeah,
2
exactly.
plus. Right, yeah.
Absolutely. Okay. In fact, let's take yesterday, for instance. Yesterday threw a lot of people off, yeah? So yesterday, we gapped upwards, right? That was Friday. We gapped upwards yesterday. This is the chart. I'm looking at the 15-minute chart.
Wasn't it Thursday? I thought it was Thursday. I thought it was Thursday when it gapped up, right?
No. Thursday gapped down.
Thursday gapped down. Oh yeah, yesterday gapped up. Okay, gotcha.
Yeah. So yeah, Thursday gapped down, right, and went down to 34.91, and then it came back, closed the gap, and ran like crazy, about 100 points, give or take, and threw everybody off. Right, biggest one-day rally in S&P for the last many years. It hasn't risen 5% in one day. Yeah. Right. And so that was actually a 5-point-something% rally based on the analysts' reports that reported on that. And then what happened yesterday? Let's talk about yesterday. Yesterday it gapped up, okay? Gapped up, and it was a healthy gap because it was from about 3670, let's call it 3700, right? Went all the way up to 3683. Did I say 3700? I meant 3670. 3670, right? So that was a really, really nice, healthy gap. And what would you have known? What would you have thought yesterday would be? You'd have thought yesterday was a green day, continuation of the previous day.
But it wasn't a strong green day. Am I correct when I say that? Because I remember specifically, but when the morning before the market opened, it was like only plus 0.37 maybe. Like it wasn't like a plus 1 point whatever like it usually is, and that it's going to be strong. It was strong before pre-market, but it wasn't that strong. I guess that's what I'm trying to say. Am I correct when I say that?
I don't remember the numbers. I usually take a screenshot, and I can't find it right now, but I usually take a screenshot to help guide me in the morning, and I'll try and find it during the course of this call. And actually this is basically what we're talking about in the market today. But either way, the direction was supposed to be up. Yes.
Right. Yeah. Right.
And you would have thought it would have continued upwards based on the way the chart looks like. I'm going to go back here to the daily. The daily time frame here is that there's a really large gap over here that everybody thought we're just going to go fill that gap, right? And me too. I was in there. I thought that we're going to fill that 3708 to 3743, right? 3743. That was my thesis. That was my thesis yesterday. So let me see whether I can find that.
I think that's exactly what I was looking at. So I mean, if I made the same mistake Eddie did, I think I didn't do too bad.
Yeah, it could have been a mistake, but also it depends on how you handled it, right? It depends on how you handled that scenario. And I don't know in your case how you handled that one. For me, I think I did do a screenshot yesterday. I always go in with a stop loss. Do you use a stop loss, Lindell?
Oh yes.
Okay, so you know what a stop loss is, yeah. All right.
Yeah, I came from IWC, so yeah.
You came from who? Just kidding. Yeah, stop loss, very, very important. But I was in that same trade. In fact, I'm comfortable showing that trade here, which is this one right here. You can see that at 9:31. Can you see my screen?
I'm driving the truck,
okay.
So I can't really look at it. I'm gonna go look at the replay.
Understood. All right. But if anybody's looking at my screen, this was the trade that I'm talking about here. I just took a screenshot. But at 9:31 a.m., I was very, very bullish. I was confident. I bought 3 of them. The 3,700 strike. Obviously, I was inside of a bracket order, and I paid 23.80, exactly what I asked for. And I was in there for about 8 minutes in the trade, got $5 out of it. But right after 9:39, you can see 9:39 a.m. I'm going to go back here to this chart here. Is 9:30 something, just before 9:45. So we're still inside the first 15-minute candle, and I trade on the 15. When it started pulling back, that is when I got out. Okay, that was when I got out. I mean, you see profit, you take it. If I had,
you was in that trade, but what, less than 15 minutes then, right?
8 minutes to be precise. Yes.
Wow. You
So,
have fast fingers.
That's a really long time. Usually we in a trade about 2-3 minutes, but we'll talk about that sometime. But yeah, 8 minutes is a really long time, especially in the first 15 minutes. But the point here is that the direction here, that when S&P opened, we saw green. We saw that this is going to be a green day, because at one time this whole candle was green. If you know how to read a chart, you understand that this candle was green, totally green at this point.
Yes, sir.
Right?
Yes, sir.
But what do you do when you start seeing the volume start to drop off or direction changing, right? What do? You get out, you take your profits, and you chill out, you decide what you're going to do next. That was my move. I did not get back into the market yesterday, being a Friday, so I was happy with if you do the math, that's about $1,500, give or take, right? Actually, more like $1,500. But to your point, and to dissect the market here, is even when the market gives you a direction, even when you understand that this is how you're going, it doesn't, or how you're opening, it doesn't mean that you're going to be there all day long. That's the mistake that a lot of people are making. They see that ES is recording a positive number, they buy that one contract or however many contracts, and then they forget it. They don't manage it well, and it ends up being a loser, right?
Can I ask you a question?
So hang on a quick second. It ends up being a loser instead of managing it very, very tightly with a stop loss, right? Stop loss or take profit. You need to take profit, and that's how you manage that situation. By the way, just before you ask your question, your exit point is more important than your entry point, because it determines whether you're coming out at a loss, or how bad that loss is, or your profit. Okay, go ahead and ask your question.
Well, I think you just answered it. I was going to say, if it had continued to go up, would you have stayed in that trade? And the answer would be no, because you already had to take profit at that point.
More than likely, my target was probably 10, plus 10. Okay. Yeah, and the reason it was plus 10 is very, very clear. I will show you what my trading plan yesterday was looking like. I was looking for an increase of S&P, or for it to try and fill that gap to the 37.43. So let's consider that I bought at the money, which was 3,700. When I entered the trade, I was expecting it to go at least to 37.20, give or take, right?
Okay. Yeah.
If you're going to 37.20, that is a 20-point move. That is usually my calculation. I need 20 points of movement in any trade, right? So 20 points at the money is how much in premium? If you're buying at the money and delta is 50. 10.
20 points would be no.
20 points would represent $10 in premium.
Why is it add?
20 times 0.50.
Got you.
Yeah. So delta the money is 50 cents, or is 50, or 0.50. Remember, when we say delta 50, we're actually meaning 0.50, right? It just takes a day and a half to say it. So when we multiply the 20-point movement times delta of 50, we're actually shooting for $10 in premium. That was my goal yesterday. But when we started moving around, I adjusted my goal downwards to just half, because when those things start flickering up and down, I'm talking about the candles, it's time to get out. It's time to get out, right? Lock the profit in. So that's how you play that. But your question was important, and it provides a great teaching moment here for everyone, that a lot of us are watching the market, the futures. A lot of us are watching the futures to guide us what happens in the morning. It's very detailed. I do this on Thursday Power Mornings with my class, and we dissect what happened overnight to see patterns and all that kind of good stuff. So there's more than just looking at the number and deciding, you know what, we're green, buying a call, run right quick to Starbucks, come back and make that money, right? Don't do that. Don't do that. Cool. All right.
Well, I appreciate you answering the question. That tells me a lot. Thank you.
You're welcome. You're welcome. Thanks for asking. Take a look at the chat over here, see what's happening. Right. I don't see any questions in the chat. Who else has a question? Anybody has a question?
Hey, I have a question.
Sure.
But yeah, it's more of asking you to elaborate on two little things that I picked up just now, because you said it's more important where you get out than where you get in.
Correct.
And then you also said when you saw that candle start flickering, then that's your cue to get out. So can you elaborate a little bit more on how much variation in movement in that, I guess, particular candle? Because we're looking at the 15 minutes.
Yes.
What exactly are you looking for to say, okay, yeah, how much flickering, is like, okay, it's time to go? Yeah.
So let me answer that question first, and then I go back to the exit point. When I'm looking at the market when I'm trading, there's several things I'm looking at. I'm looking at several symbols that correlate to each other. I'm looking at the chart of the instrument that I'm trading, which is S&P at that point. And then I'm also looking at P&L, right? So I saw my P&L go up to $2,000. And I saw it start to come down. What do you do when you've hit $2,000 and now you're at 17, now you're at 16, now you're at 15? What's in your mind? Tell me what you would do.
By the time it reached to 15, you probably say, yeah, it's time to get out. I'm not willing to lose any more than that.
Exactly. Not even lose. Yeah. I don't want to give up more than that, right?
Right.
I am human. I did exactly what you said. It is the way that I work. That is the way my brain works. If I see that, I did not make an arbitrary decision that, I'm at 13, I'm at 14, I'm at 15, how far can this thing go and all that. I had already seen 2000 because I'm looking at P&L at the same time on a different screen, and I can see that, I hit 2000. I'm almost at my 3000 target, right? Remember, my target was $10 in premium. So at 2000, I was like, all right, 10 more, or $1,000 more to go, right? Then we'll get there. But when you start seeing it decrease, and $500 is a lot. Anybody think $500 is not a lot of money? I think it's a lot of money. So when it decreased, I'm like, I don't know what's happening. This looks like it's a fake out. So I was also looking to see, let me tell you what else was guiding me. I did also go into the 1 minute. I have to say that I did go into the 1 minute. So this was my trade here. And when it started coming back down very, very strong on the 1 minute, I saw that there's a likelihood it will come back and try and fill the gap that was there in the morning. And that was a huge gap. You don't want to give up $1,500 and hope that it's going to cover the gap and then come back up. No, you take the $1,500, you wait for it to fill the gap, and then you see whether it's going to work or not. Yes?
Yes.
So
Yes.
you take your profit when you can, not when you have to. That's a good example. So
Okay.
and
Yeah,
that's how
I
you make the
appreciate that you said you went down to the 1 minute, because that's very helpful, because that will give you a little bit more insight than, like minute by minute what's going on, as opposed to the 15
yeah.
that can help.
Now I stay on the 15. I have to be very, very vocal about that. The reason, and I've got multiple charts. I don't have just one chart, by the way, right? So I've got a screen that shows me the 15. I've got a screen that's showing me the 5 and the 1. I've got other screens on my, I have multiple screens, the Dow Jones, the NASDAQ. I want a good picture of the market, right?
Okay.
But the P&L is telling me the actual numbers. I don't have to look at the 1 minute to see that I'm losing $100, $200, $300. I don't need that, right? So I've trained my eye to keep, train myself to keep an eye on those numbers as they move and adjust my take profit accordingly, fairly quickly. That it's that mechanical part that you have to build a really good motor skill. Just how to work with your program and know what to do, when to do it, how to do it real quick, without having to open up the manual.
Yeah.
Okay.
So I know you usually have a stop loss, but do you usually have like a percentage, like you were at 2,000 and then you saw it go down 500, you're at 15. Do you have a cutoff or a percentage where you're saying, okay, I'm not willing to lose any more of my profit, so this is the point where I will cut the trade? Or as you're saying, you're looking at everything?
Yeah, pretty much everything. And I don't have a good handle. I keep saying that I can't multitask a lot, right? I need to focus. So for me, I'm totally focused on that one trade, and you can make a decision fairly quickly. I've been in there a lot of times, right? More like every day, several times a day. This is what I do. So to me, it is not, I don't have to call a conference. Let's talk about these guys. Should I take the profit now or not? No. You make
You're
that
more
decision real quick.
reflexive.
Yeah,
Yeah.
it has to be reflexive, and also I don't argue with anything over $1,000, right? So if you know my trading plan, you know that my target every day is $500. I usually outperform that many times over. So when a trade gives you $1,000 plus, you just take it. You already got your profit. There's nothing to think about. Yeah. Your first question was on the exit. So I think we talked about that, as part of this conversation. You don't have a choice. Once you enter the trade, you have to make a decision. There's no choice, right? If you don't make a choice, guess what? It goes to zero. Or it could go well.
Right.
Or it could go well. Caroline says that she saw a trade on Twitter that lasted 5 seconds. Yeah, I've done that too, many times. It wasn't 300 contracts though. I don't do 300 contracts. I do 3. Yeah.
So Eddie, you're saying don't get in the trade, well, because you don't have hindsight, and just leave it open and say, okay, I'm just going to stay in it as long as it's going my way. It's better to set your exit.
I always set my exit. Yes. Always set my exit.
Okay.
And
as you were,
part of the reason is I don't wait for this candle to paint in order to make a decision. Remember, this candle painting on my screen, that is historical information. It has already happened.
Okay.
A lot of times I make my money inside the candle using my bracket order. Because if I was to wait until this candle is green and then start, pushing the buttons here, time to sell, no, it was time to sell. right?
Yes,
So,
that makes sense.
all right, good deal.
Eddie, if I could just say something. Good morning.
Yeah, hey, good morning, Gil.
Yeah, I think your strategy though is specifically to SPX. What I'm hearing, the person was asking, sometimes you can swing trade. That's a whole different strategy.
Absolutely.
Than day trading.
Yeah. Yeah, and that's a great point there, Gail, because a lot of people are doing day trading thinking that they're doing swing trading. They have the mindset of a swing trader, but they're trying to apply it to a day trade or vice versa, something like that. And so these miniature fluctuations intradays are confusing everybody. If you just go with a long term, which I've been preaching here about, for pretty heavily last few months, S&P is messing up a lot of people, right, with the calls and the puts because of the wide swings. I mean, you can see on the daily here that 100-point swings are not uncommon these days. They didn't used to be that common, but now they're becoming the norm rather than the exception. And here's the deal. How do we explain that? Right now, the VIX is at $32, right? $32 implies, if you do the math and you look at the statistics, it implies that the S&P is going to fluctuate between 1.5% and 2% on any given day. Let's let that sink for a minute, right? On any given day, you can count on about 1.5% to 2% when the VIX is that high. Remember, it's a fear index, but it does give us a really high volatility because we also use that to calculate the volatility, the implied volatility. But in layman's terms or easy to understand terms, it just simply means that if S&P opens at 35.83 tomorrow, and it closed at 35.83, and the VIX is at approximately 32 to 33, then we can expect about a 1.5% swing. So let's do the math here. 35.83 plus 1.5%. Can we expect this to go to 36.36? The answer is yes. That was only 1.5%. Right? Can it drop 1.5%? Let's do the math. 35.83 minus 1.5%. The answer is 35.29. Can it do that? Again, the answer is yes. So you can see that it is about a 1.5% to 2% fluctuation. That's a combination of both. It doesn't have to be necessarily just one straight direction. So, yesterday and Thursday were anomalies because those were 5% days. Thursday specifically was 5.5%, I think. Right. So the average is about 1.5% to 2% when the VIX is well over 30. Once it comes down to about 20 to 22, then we're going to see our normal-ish. I don't know whether there's such a thing as normal now when we talk about the S&P, but it should come down. The fluctuations should lessen once the VIX comes down, once the flat fear index comes down. So just to clarify again on Gail's point, trade on a daily time frame. That's number one. Do swing trades. And if you're not well equipped to do day trades, don't do day trades, right? Don't go in there in the morning and the profit that you're looking for in several days, you're trying to look for it in 2 minutes. Let that trade bake. And maybe S&P is not for you. Maybe it's time to just say, you know what, this is not for me. First and foremost, it's a very expensive stock, yes. It moves too fast, burns me all the time, takes my money. When it gives me money, it gives me some money, what the heck, here's $5, no? So maybe S&P is not the right thing for a small account. It is the right thing for a small account with the right strategy, which I can show you, right? But it is not the right account if you're going to do calls and puts. So what do you do? What other alternatives are there? Again, look for stocks that are moving at least $5 every day. Talking about ATR here. Go long. Increase your expected movement requirement, right? So we know that, in order to get a really good trade, we've been talking about $10 expected movement. Increase that to a higher number that gives you more liquidity, and for stock that has more liquidity and moves a lot. So that would be my advice to work in this market. Avoid S&P if you can until you're ready for it. Let's see, look at the chat, see what other questions you guys have. All right. No other questions? You all good? Marsha is asking, can you please explain what is the expectation on price direction move on the put side for debit spreads? Marsha, I can, but I don't teach debit spreads here. I teach debit spreads inside my class because I have a very, very specific way. I've got some tips that work most of the time very well. Double your account in no time flat. So hit me up on the site. Okay. Cool. All right. What else did I want to talk about today? I think we talked about the market. So what could you have done with the market if once you saw this, and this is more for probably people who have maybe liquid cash, on the side, and wanted to take advantage of these couple of days. So what exactly could you have done in this scenario? And we talked a little bit about this on Thursday about it. So first off, learn to read the market, learn to read the charts really well, understand price action. So don't just go for those, support and the resistance. Also understand how price works for the particular security that you're working with. So looking at S&P, which is the one that I trade the most, I knew, well, is that the right word? I didn't know. My gut feeling, it wasn't even gut feeling. Everything that we looked at, because we looked at this objectively, and I'm not just saying this because this is hindsight. We actually had a meeting at 9 o'clock on Thursday before the market opened, and analyzed what was potentially going to happen. Remember, your edge here is you don't know what's going to happen, but if you can have something that gives you information, an additional edge, then you can improve or increase your probability of success. So that's how you want to do it. So we learned that with a big drop on Thursday, which was actually 77 points, the likelihood of that continuation was not going to be very, very strong. We were projecting about $15, which was failing to meet our A+ trade. It was failing to meet our A+ trade for S&P 500. We talk about that A+ trade inside class, but we need, my group or my students need an A+ trade in order to buy a put. And we summed it up way before the market opened and said, no, we're not going to buy puts. But we had no idea that we were going to go anywhere past the gap. Our thesis was that once price turned around and hit that number that we had projected, which was actually, somebody remind me, what was the projection on Thursday? Let's see who's in class. Gail, were you there? No. I think it was 35.
I wasn't, but I think it was 35. I looked at it, yeah.
Yeah, it was about 3,500, something like that.
Something,
yeah, that was our projection. So that's what we were looking at as a turnaround point. And once we hit that turnaround point, once we hit that support level, for sure, it turned around and gave us that indication that the market had turned and now it was time to go up. But we still could not enter a trade until we had confirmation that we were now inside this gap, the open range breakout. We didn't have a breakout until maybe 10 o'clock, 10:30, give or take. And that time it became a gap play. So it wasn't yet a rallying day. It was simply a gap play. I think we were calling 35.55 at the time. We hit 35.55, pulled back, and we thought, it's good. Yeah, and we thought that everything is all good, but then it ran up. So what could you have done if you were a swing trader, right? If you were a swing trader, first and foremost, you would not have known this would happen. What you would have known is that we've hit the low, 52-week low, right? 52-week low, I believe. Let me verify that. On Thursday, we hit the lowest point in about a year. Is that about right? Anybody? I think so. I think that's what.
Yes, you're correct. You're correct.
Yeah. So that was a buy the deep kind of scenario. That was a buy the deep. I'm going to bring up here, bring it, this chat here, and I'm going to switch over to the daily. So yeah, this 34.91 was actually, a level that we had not seen since November 2020, right? It's a long time ago. It's like 2 years ago. Some of us guys were not even born. It's a joke, guys. Come on, walk with me here. Walk with me. All right. But anyhow, you would have understood that there was this gap right here that we were trying to fill. There's this gap right here below. If we tried to fill that gap, that would have been a dangerous gap. But was there enough momentum to go down there? That didn't look like there was enough steam. After dropping 77 points in the morning, we understood why. First and foremost, why did it drop 77? There was the CPI numbers that came out. People did not understand them. They didn't like them. Market dropped anyway, right? And the reason that the market dropped is because people were confirming based on the CPI numbers that the Fed was not going to do anything other than what they've been saying that they will do. The only thing that would start moving the market higher is if the Fed said, you know what, guys, we've been talking about increasing these to about 4.6%. I'm talking about the interest rates. We're going to go down to 4.25 or 4. That would make a huge difference. But it's not. He's not going to do it. They're bent on fixing inflation. But the point here is for that trade on Thursday, if you are going to trade, then perhaps in hindsight here would have been to buy maybe a 30-day call on SPY or whatever ETF that you could get for an inexpensive price. So that would have been my take. If I had to do this in hindsight, I would have bought maybe a SPY call or a VO call or something else on my watch list that I would like. I've been talking about buying Tesla, but I didn't even buy that, by the way. Didn't even do that. So mute this guy. So there we go. Buy the deep. That's what buying the deep is all about. Buying the deep. That's what it is. When you see prices come down tremendously, you buy the deep. When you see prices hit a particular point and turn around, like yesterday, we had no idea that once we hit this level, it is going to drop. But here's another tip I can tell you. When you learn how to read the candles, you know that when you have these long candles, what's going to happen? Anybody have an idea what's going to happen when you have long candles?
They have to fill. They're called imbalance candles.
We have to balance them out. It's not a gap. It's not a gap, but you for sure missed out quite a few orders when you ran up real quick. Yeah, it's like the plane. It's like going to the airport and you have a big jumbo jet and it goes out like 5 minutes before schedule. Right? They decide, people are not showing up. Guys, looks like everybody who's going to show up has already shown up. Let's hit the runway. Let's roll. Right? 20 minutes later, the airline said, dude, man, everybody showed up. So what do they have to do? They have to go send back several planes to fill up. Maybe you had a 747, now you need a few Cessnas to carry all those people. Anybody military? Yeah, maybe a C-130. I don't know, something. So have a plan in place that for strong pullbacks. That's how I would play that. The other thing is, in the same token, when you have such movements, let's say you were in the wrong direction, because it happens to us all the time. If you're in the wrong direction, it's not that you purposely did that. You just got your numbers wrong, or the data that you were using turned, or became, changed. They took on a new form. And so to protect yourself, you need that stop loss. We talked about that stop loss, or we talk about stop loss over and over and over and over again. In fact, you ever call me, the first thing I ask you is,
and then there was a cord over here.
Okay, right. So yeah, first thing I usually ask is, what was your stop loss, and how did that work, right? How did that work? So sounds good, everyone? Okay. So I've got a hypothetical question now. This is I'm going on to the next topic here, unless anybody has a question, real quick question. No? Okay. So you have, let's see, you've got $10,000, right? $10,000. How do you spend it? Let's get some ideas. How do you spend $10,000? And your job or your MO is to trade in the stock market. How do you allocate that 10K? Anybody have any ideas?
I'd buy Eddie's course.
Okay, that would be the best buy that you can make. All right, and then you'd still be left with some money. What would you do with the rest? Let's just say you had $10,000. You've already bought the course. You're now in the stock market. You're trading options. What would you do?
I'd spend the rest of the 7,500. I would probably 1/3 of that. The rest of it I would use to trade.
Yeah, well, that's where the question is: what would you trade? How would you trade?
Half of it I would buy stocks. The other half I would use to trade options.
Okay.
Not the SPX though. I wouldn't start out with SPX.
Yeah.
Something else that I knew pretty good.
Okay. Those are great answers. Any other answers? Leaps. Okay. Leaps. Somebody says that would, but that's the only money you have, by the way. You just have 10K to spend on trading. So you'd think leaps. Okay. Does everyone understand what leaps are? Leaps are long-term equity anticipation securities. Right. All right. Antonio would trade SPY. Okay. Janae is getting on the right track. Invest 8K, save 2K. Regina, that's what she says. All right. Well, let me give you some answers. Right. This is not a financial advice. I'm not telling you what to do. Let's first make that clear. This is just, we're playing a game here for education. So if you had 10K, what you want to do is, and not just 10K. 10 is just a number that is easy to say, easy to write out as well, easy to do math on. If whatever the size of your portfolio is, we're going to assume that this is just a regular account. It can be cash account, it can be margin account, doesn't matter what it is. And also we're going to assume here that your trading strategy is maybe 2 or 3 times a week, right? Maybe 2 or 3 times a week. So that's the assumption here. The other assumption here is that you don't have the luxury of trading every day. So you're in the US and you have PDT restrictions because you don't have 25,000. We know that when you have less than 25 in a margin account, then you can't really trade more than 3. You can't have more than 3 opening and closing trades in a 5 business day period. And even if you had a cash account, even though it allows you to trade every day as many times as you want, there's a misconception about cash accounts. Let me clear that one up first. If you have $10,000 and you spend $8,000 on a trade, okay, spend $8,000 on trade does, gives you $200. It's a really bad ROI, by the way. So 8,000 and you get $200. So now your account value is 10,200 after you close that position. Anybody disagree on that? Or everybody with me? Yes. Okay. And then a great opportunity like yesterday's or Thursday's comes around and you need $5,000 to trade. Can you trade? Marlon says no. Antonio says no, it's unsettled. No. Anybody answer? Anybody think yes? Okay. The answer is no, you cannot trade because you don't have $8,000. And Marlon gave us the correct answer. It's because it's unsettled, right? And it also depends on what instrument you're trading. If you're trading S&P, it's going to settle next business day. If you're trading SPY, guess what? It doesn't settle for 2 days, 2 whole days, 2 business days, because it's an equity. It's not cash settled, right? So if you're trading a cash settled instrument like S&P or NDX or DJX, then yeah, tomorrow it's going to be available. But if it's anything else that is not cash settled, like SPY, like QQQ, SQQQ, Apple, Tesla, whatever, then it settles in 2 business days. It varies from broker to broker. It may be available to you earlier, but so for that reason, we're going to assume that you're only able to trade with your small account just a few times a week. Shall we say 3 or 4 times a week? Anybody can argue with that? About 3 or 4 times a week, right? About 3 or 4 times. So I'm giving you a formula over here. So we're going to start with 10,000. We are not going to put all our eggs in one basket. Yeah, we understand that saying, right? Is that an international idiom? I think everybody around the world understands that, right? Because I see we have people from the UK, we have Canadians, we have people from Africa, we have, I don't see Asia today. Nobody from Asia. But anyway, I think everyone understands that when, the term "don't put all your eggs in one basket" means that if you have $10,000 to spend, don't go spend it all in one place. That's the general advice. At least split it out. So here's what we're going to do. We're going to keep 20% of that in cash, right? So let's do some math here. So 10K times 20%, we're going to put $2,000 in cash, right? $2,000 in cash, and that is going to represent that we now have $8,000 to spend. $8,000 to spend, and we're going to spend maybe we're going to do about 4 trades. What do you guys think? About 4 trades. So if you have the capability to trade 4 trades or 4 positions, and you decide to do them equally, how much would you have available for each position? Somebody type it out there, please. So you've got $8,000. You want to do 4 trades or 4 positions, and how much would be available for each? About 2K. Yeah, you guys are good. You guys are good. Can you buy options with $2,000? Yeah, you can buy. A lot of options costs $2,000 or less, much less, in fact. So that's how you plan your portfolio first and foremost. When you're building your trading plan, think in terms of how many open positions that you will have, maximum open positions. I would suggest 3 to 4, sometimes even 2 to 3. I would start off with maybe 1 or 2. Do you see how the number is decreasing? I would go down. I would rather start with 1 or 2 positions, or if I'm still shaky in the market, I don't know what I'm doing, just do 1. We went from 4 to 1 in about 10 seconds. Start with 1, move on to 1 to 2 positions. Even with your 10K, it means that you're going to have a lot of cash not working for you. But remember, your budget here is that each position you cannot spend more than 2,000 based on your plan. Yes? No? Maybe? It takes a lot of discipline. Right? It takes a lot of discipline. A lot of people going in saying, I have $10,000. I need to make 1% of that money. I need to make 5%. I need to make X percent, right? Which means that I'm going to spend all 10 to the maximum. If I have to go to S&P and buy 3 contracts and each of them is costing $3,000, I can afford 3 contracts at 3,000 each. Who are you to tell me no? Right? That's the easiest way to blow up your account. I've been there, blown up an account. I know how to blow up an account. I can blow up an account with my eyes shut. I know Lindell can blow up an account too. I believe in that man. Right, Lindell? You can unmute.
Unfortunately, I know a lot about blowing up accounts.
Yeah. I know Gil can blow up an account. Yeah. Look me in the face and say you can't blow up in an account. We'd be having a laughing party, right? Okay. Audrey, you got that backwards. 20% in cash, 80% is what you're going to trade. Right? 20% in cash, 80% is what you're going to trade. Out of that 80%, we're going to divvy it up into 4 trades. We're going to have 4 potential positions, right? And it means that each position, we cannot spend more than 2,000, right? Can't spend more than 2,000. So that means that any trade that you go into has to fit inside those parameters. We're doing budgeting here. This feels like budgeting 101, right? It's a spending plan. It's an investment plan. What does this do for you? It means that each position is representing 20% of your whole portfolio. Is that about right? That's about right, yes? It is right, 20%. We also are taught that you don't want to risk more than 20% of your portfolio on one trade. That's a huge rule. It means that if everything went bust in a one position, then that is 20% of your portfolio. That's a huge amount. That's a really huge amount. So we're managing that portfolio by also managing what our maximum risk is on a trade. So if everything went, if you just lost 100% on your position, you'd be losing $2,000 as opposed to $10,000. So work with me here. Decide how many trades you're going to do. Divide your portfolio by that number, and that is your maximum risk, no matter what. And then we're going on the bigger picture. We're going to go down to risk manage on a position level. So now that you have $2,000 in available for each trade, you have to go find something that gives you roughly 10%, right? Roughly 10% return on investment. What's 10% of 2,000? I'll just give you the answer. Yeah, it's $200. Anybody know how to make $200? Just buy something in the money and wait for it to move $2. Yeah, that's what you do. Do that on a regular basis, 2-3 times a week. Remember, you've got the ability to do up to 4 positions safely with your account of that size about 3 or 4 times a week. Any questions on that? Who's got questions? Who's got questions?
Eddie, I thought the PDT is strictly 3 trades per 5 days.
Yeah, it is. Three in 5 business days. And you can blow up all 3 of them in one day. Yeah, you can do that too, right? But when you have a cash account and when you have a disciplined approach, then you can manage your account in a way that you don't run into PDT issues. You never run into PDT issues. So swing trades, don't do day trades because you don't have enough money to do day trades. You don't have enough latitude to do it, right? So, here's the other thing. If you enter into a position and you still have your 4, let's say you still have your 8,000 at the beginning of the day, your trade, that when you enter a trade, you can only trade $2,000 of that, then you have an opportunity to recover if you must. But if you spend all 10, like in the example we did where we spent $8,000 and now you have another position that comes up that needs 5,000, you don't have 5,000 because your cash has not settled, right? Or if you had a margin account, yay for you, but now it means that you have to use a day trade. So you have to choose. So whether you have a margin account or whether you have a cash account, it doesn't really matter. When you're trading options, remember margin here just allows you to use that money as soon as you close the position. It doesn't mean that you're borrowing from the broker. No, you're not. That's for stocks. Okay, that's for stocks. Because stocks, they give you leverage 2 times, 3 times, 4 times. You don't get leverage on options when it comes to margin. Okay. I'm sharing on my screen here an example in investment plan over here. Do you see what I'm talking about? I'm now giving you the picture here, just so that and maximum contract size here really should not be 5. This is old school. This should be 3. Does that help? Okay, it helps. It goes further than that because you can also now decide which 4 well in advance in the middle of the week or at the beginning of the week. You can have, an idea about what these stocks are and how they're moving, in which case now we can go into something like this, which is more of, you put your stocks in there and you get these values in there and all that kind of good stuff. So since that we're not talking about that, I'm going to hide that for now. All right.
Eddie, is this still in your class?
I'm sorry, what was the question?
The spreadsheet.
Yes.
Is that in your class? I don't remember that.
It is. It is. Yep. Yeah, it's inside the shared folder. So if you don't find it, just let me know. But
yeah,
it's
definitely.
Yeah. Cool.
I learned a lot in class, but I need to go back. Like I said, I bought a house that took all my account money, so I need to go back and get a refresher because I'm getting back into it.
Awesome. Yeah, we'll definitely help you get back. Did you say you sold your house to get into the market, or the other way around?
Other way around. A buddy of mine was selling a house and the deal was too good, so I had to pull money out of my trading account for the down payment.
Okay. Cool.
So I'm trying to build back up.
Got it.
But I'm like weighing up an equity on the house now, which is good. So.
Awesome.
Trade one for another.
Cool. So I have a question. if you have, let's say 2023, let's talk about some goals for 2023. 2023 goals. Can you make $100,000 starting off with, well, let me get some laughs here. Get some, warm up the crowd. How much do you need to make $100,000 in 2023? How much needs to be in your account December 31? Assuming that you're going to have a mix of wins and losses, 7% win rate, 30% loss rate, and your target is cash in the bank. You need at the end of 2023, you need about 100,000. How much do you need? The answer to somebody asking a question, if you have 2,000 or less, should you be swing trading? The answer is yes. Even if you have more than 2,000, you should still be swing trading. Yeah, that is important. Guys, don't day trade, right? Don't day trade. Day trade is not for, you're not equipped to day trade. You need a few more tools to do that, right? A lot of knowledge and a lot of tools and a lot of flexibility to be able to recover. So don't do day trades. Where am I going with that 100,000? I think that based on my experience, you do not need a whole lot of money to make $100,000. You also don't need huge wins to make 100,000, right? So if we decide to estimate how long it's going to take to make that 100,000 in 1 year, there's 52 weeks in a year. Do we trade every week and are we successful every week? No. So could we comfortably use a number like 40 weeks? So remember, today we're talking about, portfolio management and basically budgeting. So we're budgeting our time here and projecting our trading. So we have about 40 weeks. Maybe we can say that we have 40 good weeks to trade in 1 year. Would that be a good assumption? Some people go with 48. Some go with 36. 40 sounds like a good number. What do you guys think? 40? And this is quiet. Yeah, 40 is good. All right. So 40, it means that if we divide that 100 divide by 40, we need to make, I have to pull out my calculator here. We need to make about $2,500 a week. And I'm going to stop here in about 6 minutes. So we need about $2,500 every week for the 40 good weeks. We know that there are more than 40, but we need to pick about 40 good weeks. But on average, if we can make about 2,500 as a target, that would be good. That's assuming also that you're paying yourself, right? Every week you're paying yourself, which is possible to bank 2,500. Maybe out of that you're paying yourself a little bit of money, but you're shooting for 2,500 net. So how do we make $2,500? We need to talk about that seriously. Is it possible to make 2,500 every week or in a week or most weeks, more like 40 weeks of those? The answer is yes. And I want to teach you how to do that. So hit me up, options with Eddie. I definitely want to help you guys make that next level. You don't have to target 100,000. But if you don't have a goal, you're going to hit it, guaranteed. All right. If you don't have a goal, notice how I say that. If you don't have a goal, you're already there. So that is the deal. But I think, well, we ran out of time. We only have about 4 minutes. I did have a plan that can make you that much money, but we need a bit more time. We need more like 30 minutes, but I have a run to make. So How to contact me? Does anybody know how to contact me? Does membership in options have an expiration? No. Once you join, you become part of the community. You become family. So even though the class is only 8 weeks, that's just the curriculum. The fun starts after that, or continues. The fun starts. So options with that. Thank you, Gail. Yep. And if you want to email me, just add info@optionswitheddie, and that email will come to me. So very nice. Any other questions here in the next 2 minutes? Because that's about all I have. Any burning questions? Next class, by the way, starts on Tuesday. I have a maximum of 10. So there's Tuesday and Wednesday. How to exercise an option. You just simply go into your brokerage platform and click on exercise. If you go into the monitor section and you have an option that is available, then you will have the opportunity here to exercise. So I don't have any open positions here. I'm in my sim account. But if you are inside your live account and you have a call option or a put option that is live, and you want to exercise your option, then you simply right click, and the question there that Caroline is asking, how to exercise an option, she's referring to turning your option contract into shares. Let's say you bought one call contract for $10 at the 140 strike. You're basically telling the broker, convert this options contract. I want to exercise my option here. So I want to actually buy the 100 shares at the 140 strike. So remember, when you buy a call option, you have the right, but not the obligation. You're simply locking in the price at that particular strike. So there's very few instances where you'd actually make money by exercising your own option, right? So, but there's more to it than just that. There's a metric that you can look at that tells you, is it advantageous for me to actually exercise these than to sell it? A good example would be when you have a stock option that you purchased and the price has gone up tremendously, way past your break-even point. And now if you exercise that option, you'd actually be at a huge advantage. There's more to it than that. So cool. It is now 12:30 because I have to actually take off. And I don't want to be late. I'm going to sign off here. Unless there's anything else. Any stop sharing here. All right, Masha. I'll be looking out for your email and all that good stuff. So, all right, guys. Adios.
Thank you.
All right. Bye-bye.
Thank you.
Bye.